Um, I'm not sure this is going to appeal to too many people because there's a lot of people that invest in stocks and they do really well. They do really well, and a lot of people are dividend investors, but um, but they don't know. A lot of them don't. Some of them do, but I mean, a lot of them, I wouldn't say, know how to value a business, and you don't know if something is cheap or something is expensive. You just say, "Oh, well, I like Tesla. I'm gonna buy Tesla," or or I like Bitcoin. I'm gonna buy Bitcoin. You know, you there was something that happened many years ago in the Dutch lands, and they had it was called Tulip Mania, and what people were doing was they were selling their homes, they were quitting their jobs to buy, wait for it now, tulip bulbs. And the price of tulip bulbs was so absurd that you could sell one tulip bulb and have a year's salary. Now, to me, this almost sounds like Bitcoin in recent times because Bitcoin was less than $1 at one time, and then it went to $60,000. And then next thing you know, people were talking about it's going to $1 million for one coin that doesn't produce anything. You can't buy anything with. Well, you can't go to Walmart and pay with Bitcoin. You can't pay your babysitter with Bitcoin. To me, I think it's worth zero, and people were thinking it's $1 million, but if you have some FOMO, some fear of missing out, put 1% in it, and if it goes to $1 million, you do okay. I had invested in my own little crap. Excuse my language. I'll say crap coin because I thought it was worthless, but throw a couple $100 in it, and maybe it will go up to the moon. There was people putting their whole savings, $50,000-$100,000 savings. All into Dogecoin, and some of them got very rich. At one point, if you had put $2,000 in there, stimulus money. People were getting those free stimulus checks. I wouldn't say free because we got charged 14% interest and housing, food, and gas was over 50% in gas, but so it really wasn't free money because there's no such thing as a free lunch in economics. Somebody has to pay for it. If you're not paying for it, that means that someone else is. Someone else is paying taxes, or someone else that but anyway, I don't want to get off on too big of a tangent, but I'm just saying that value investing, most of the stock people that buy and sell stocks, they're technical traders, they're day traders. They don't value what a company is worth and decide what their price is, what that company is worth, and whether it's cheap or expensive. They base their opinion on whether to buy it or not. a lot of the day traders, they look at the graph and they see a green candlestick and a red candlestick, and they have the MACV on and look at the volume and see what's going, and then they buy and sell that way. And some of them can make a lot of money that way, but I don't know too many billionaires that were day traders. I don't know too many people who got rich, they have over $100 million or so, or $100 billion that do that for a living. The most people that get rich in this country, they invest in a couple good companies, and they invest. I remember one time I saw this one guy had bought Disney a long time ago, and every year he just bought 1,000 shares or 100 shares or whatever it was, and next thing you know, 20 or 30 years later, he's a multimillionaire. Just because slow and steady wins the race. I mean, instead of getting rich quick, which everyone wants to do, they got rich slowly. But there's a million different ways to make money investing in securities. Dividend investing is a good way. And like I said, it depends on your preference. Like me, my preference right now, I'm going for cash flow. So I want a higher return, but a lot of times that's more risky. If you're buying a stock with a very low dividend, you're expecting the value of the security to go up, and you're expecting for the next 20 or 30 or 50 or 100 years, their dividends will increase over time. Like Coca-Cola, for example, Buffett had bought, I want to say Coca-Cola at $1.50. I could be wrong on that, but I want to believe that he bought it about $1.50, and now the dividend's almost $2. So he basically gets more in dividends than he even paid for it. And plus the stock went up to, I don't know, $64 or whatever it is today. But anyway, this guy, Bruce Greenwald, he is. I try to learn from the best, and if Warren Buffett's one of the best, well, who did he learn from? Well, he went to Columbia Business School. His teacher was Ben Graham, and taught him a lot and read his books. But anyway, this is a short clip on what I was talking about before about ugly, cheap, and I just want to play it for you.
For things that are ugly, cheap, boring, out of fashion, small and obscure, or otherwise on the other side of the existing finance industry mania.
If it's on the recommended list at one of the big retail brokerages, my advice to you is watch out.
Value investing consists of a basic approach to the process of investing. The first thing you have to do is identify potential investments that you're going to look at.
What you are looking for is stocks that are obscure. It's stocks that are small capitalization, because big institutions aren't going to be able to afford the time to concentrate on analyzing those stocks in detail.
When you have identified a security that you're interested in, you still have to figure out what is that security worth.
Not all value is measurable. If we were sitting here at the height of the internet boom, I don't think anybody knew what those internet stocks, not even God knew what, or I don't want to particularize. Not even any of the many gods around the world knew what those internet stocks were ultimately going to be worth.
There is a value approach to valuation, and this is really what distinguishes it more than anything else, starting to look at the balance sheet, which most people don't look at. Most people project earnings. What Buffett has added to this is a systematic way that's much more intelligent than the standard valuation approaches for looking at growth stocks. A good valuation approach will also clearly identify the critical information that you are uncertain about and that is going to focus your research effort.
When you add bad information to good information, what do you get? You get bad information. It's not a good way to go about trying to pin down a value.
So it's in the area of how you look for stocks, how you value stocks, how you focus your research and collect all the relevant information, and ultimately how you analyze and manage risk and construct a portfolio. That value investing is very different from almost all other current practice. And the evidence that it's successful is that if you look at, in every dimension, what investment strategies are successful statistically, overwhelmingly they're the value strategies, and modern financial academics have established that beyond a reasonable doubt.
You want to go to the part of the market where other investors are crazy, either crazy on the optimistic side if you're a short seller, or crazy on the pessimistic side if you're going to just be buying stocks. So you've got to look intelligently for those opportunities. You've got to ask, where is the craziness today?
What creates opportunities is the fact that most investors and most human beings are constitutionally oriented to buying lottery tickets. They love to buy the dream. And when money is going into the dream, it's leaving other areas. And it is that tendency of human beings to pursue those kinds of get-rich-quick opportunities that creates the value opportunities for the plodding, careful investors. It's painstaking, it's careful. You don't buy your stocks all at once, you buy them over time because you recognize the market fluctuates. You start with a good price, and to your shock and surprise, the stock actually falls. And you got to be ready to buy more in a slow, steady, confident way. My job, given that I've decided to concentrate in the area of investment management, is to improve the way people deploy their wealth. And this is the best mechanism for doing it. And I think if they're doing it for their clients, they're going to do a much better job for their clients. If they're doing it for themselves, they're going to do a much better job picking good managers or deciding where to allocate their money. And if they're professional managers managing for people's retirement, that's a huge gain to society at large.
You want to look for opportunities that most investors are turned off by, non-glamour stocks that may not be growing that rapidly. When a stock is ugly and bad, people are sure it's going to lose money. When a stock looks good, they're overly confident that it's going to